In this lecture, we're going to do some correlation analysis. And the reason this is valuable is because you can draw certain principles from this. And once you have these principles or rules, then you can apply them to your investment strategy. A lot of it is kind of intuitive, I suppose, but it's very good to have the data there and to validate these ideas, let's say statistically. So let's get into it. Now, the first data set I'm going to show you is from a spreadsheet which I've shared in a previous lecture. And this shows the MSOA data. So there are 8,000 or so MSOAs in the country. And what I've done is aggregated social grade data with this. So therefore, each MSOA is between 5 and 7,000 houses. And I've looked at the median house prices, the social grade, as I said, and then kind of put it all together in some kind of overall structure. And in this case, I've used pivot tables and correlation analysis to do this. So one of the big correlations that I've found is that looking at the historic data going back to 0207, so this would be the market on the way up on the last property cycle. And we can see here that areas which are dominated by AB, social grade AB, are tended to not rise in value as much as areas dominated by C2 and DE. So in other words, these areas here were, let's say, more kind of bought out. In other words, property prices were topping out, relatively speaking, and people felt there wasn't value there. And therefore, they tended to end up buying in areas where there was more value, i.e. social grade C2DE. And then on the way down in the market, what we found was that the areas with higher social grades tended to suffer less in the decline. So they had lower declines in value versus the areas with C2DE, the less economically robust areas. And then if we go from 2007 to date, I mean, it could have been 2008, there were prices kind of topped out around then. But what we see is that, again, the higher social grade areas have done better long term, lower social grade areas not so well. And then here we see from the bottom of the market coming up to today, these better areas or areas with higher social grade have done better, and the lower social grade areas not so well. But now we're in the next part of the cycle, i.e. the current boom phase, which is analogous to 2002, 2007, that kind of time frame. And what we're seeing, which is what I see every day, is that these more expensive areas, i.e. the social grade C1 areas, etc., a lot of people are just not buying there, and prices are kind of topping out. They're buying, but prices are kind of topping out in these areas. And therefore, what we're not seeing is the same kind of capital growth as we see in the lower demographic areas. What's the lesson from this correlation analysis? Well, that you should always buy in the best area you can possibly afford within reason, and the reason being you get decent yield, and you're buying a property that people actually really want to live in, and thus it'll rent well, assuming that the rental demand data is kind of matches up with your expectations. So that's that one. And then I'm going to show you this one here. So I'm not going to dwell upon too many of the signals. You can download this spreadsheet and have a look at it in your own time and dwell upon the correlations that you think are most interesting. But the ones that I think are worth looking at, bear in mind the framework here is it's correlations, postcode district correlations. So what I've done is I have downloaded all of the postcode district property data tables from a month ago or a couple of months ago. And bear in mind, this data is in constant flux, so you should update it. If you get the spreadsheet, get a free trial of property data, and then download the data, and then you can put it into this spreadsheet, and you can look at the more temporal correlations postcode by postcode. But overall, what we see here is that obviously higher yield, lower average asking price. And we can see this across the board with different segments here, different number of bedrooms. And then if we look at some interesting things, if you have an area with a lot of sales turnover, i.e. it's a very hot local market, then yield and how hot the market is, they don't really correlate. So in other words, you can have a very hot area that's expensive, but it doesn't really affect yield. So or in other words, you can have a high yield area with a high turnover, and that's great because you know that people want to live there, but the yields are good. And the likelihood is that where you have high turnover, you also have decent capital growth very often. I mean, they tend to correlate quite well together. Another one to look out for is capital growth. And you would think that high yield or low, just yield in general, would correlate with growth. So in other words, if you have an area with a lot of capital growth, then you will have lower yields. It's not really the case. There is a small correlation. So generally you can say occasionally that's the case. So you've got a lot of capital growth in an area, provided the property is cheap enough in the first place. And remember that there is a kind of natural threshold for buy to let. It's about £200,000. Above that, yields start to decline. But below that, if you pick an area where prices are, say, £130,000, £140,000, and the growth is very strong, well, then yields will probably hold out all the way up to, say, £200,000, and then they'll top out a little bit, obviously. But what it means is you can find those special areas with great growth, reasonably low price properties, and yields basically staying in line with growth over time, which is a beautiful thing for an investor. And the other thing we see that obviously higher grade AB, will that make sense? Lower yield? Yes, of course, because AB's higher price properties, they just don't yield so well for all the reasons we know. And then also we have higher yield, higher social rent, and higher private rent. That makes sense. Another one is crime. And as we've seen from previous lectures, crime is so localized. So it's dangerous to say, well, that postcode district's got a lot of crime, I'm going to avoid that. Well, that's a foolish thing. It's really important to look at crime on a super localized level. And yes, higher yield, higher crime, but that it's not a significant correlation in my view. Now, let's just have a quick look at capital growth and the correlations there. And what we see is that the higher the price, the lower the growth, but it's not a high correlation. So that's because generally we're looking at averages here, and the London market is just one small segment of the whole country, and London market is unique. And therefore, on average, yield and price there's not too much of a significant correlation here. And here we have average asking rent. And so what we see here is that the higher the growth, the lower the average asking rent. And that kind of makes sense, but it's a correlation. It's not a massively high correlation. So what that means is that there are some areas where, let's say, average asking price is above 200,000. Well, they become unviable for buy to let anyway, and that's why you get this kind of distortion with the numbers. Because really, to make this correlation more accurate, you've got to just segment areas with lower capital growth, or sorry, lower average house prices. And if you're happy playing around with Excel, you'll have this spreadsheet. You can go and tinker around with the data, do some filtering, and you'll see how these numbers work out. And with 1, 3, and 5 year correlations, we see that they're pretty tight. So in other words, if it's got longer term growth, it'll have shorter term growth most likely. And one other thing is private rented. If you've got an area dominated by private rented, you tend to get slightly less capital growth. I broadly I put that down to those areas being slightly poorer, I would say, and less desirable. And based on other analysis I've done, you generally find that the capital growth really occurs in nice areas. And if they're over dominated by private renting, it's either because it's city centre investment led tower blocks, or it's areas that just aren't quite as nice to live in, and therefore owner occupiers, who are the main drivers behind capital growth, they're not as interested, and therefore the capital growth doesn't happen so much in those areas. Anyway, there we are on correlation analysis.